Okay, so welcome back, all of you. Let's go back. Let's go on with our lecture, and we have actually here we have the same transactions as before, but what we do now, we use the T account. We use the T account, and we do a journal entry. Yeah, a journal entry essentially means this. Yeah, this is a journal entry. Yeah, and with a journal entry, you always debit at least one account, and you at least credit one account. Yeah, debit is always the left-hand side. Debit is always the left-hand side, and credit is always the account you credit is always affected on the right-hand side. Yeah. So the first transaction is the owner invests 50,000 to open the business. Here you debit cash. It's called debit cash. And you credit share capital. You debit cash. Here you increase debit for increase. You increase cash by 50,000, and you credit share capital. You increase share capital by 50,000. Yeah. And you read it the following way: you debit cash 50,000, debit cash 50,000, and you credit share capital by 50,000. Yeah. One thing you might ask: why do I debit cash and it increases, and why do I credit share capital and it also increases? And the reason is that cash is an asset account and share capital is an equity account. It's a normal equity account. Yeah. Do you see that here? Cash is an asset account. When you debit it, it goes up. Yeah. It's an asset account. When you debit it, it goes up. And share capital is an equity account. When you credit it, it goes up. Yeah, when you have to credit it, that it goes up. Yeah, it's the other way around, and this is important. Next transaction. The company buys land and pays cash of 40,000. Yeah. Here you debit land, goes up. And you credit cash, it goes down. So here, cash and land, both are asset accounts. Debit means up. Debit means debit for increase. And when you credit an asset account, you credit it, decreases. Yeah, and debit is always the left-hand side. Debit is always the left-hand side of an account. Credit is always right-hand side of an account. The next one, the firm the firm buys supplies on accounts payable for 3,700. Here we debit supplies. We debit supplies, and we credit accounts payable. Yeah, supplies asset account. When we debit it, it goes up. Accounts payable is a liability account. Yeah, so this is a liability account. This is an asset account. Accounts payable is a liability account. When you credit it, it goes up. Yeah, it doesn't go down, it goes up. Yeah, this is, you see that here? Asset accounts are different than liabilities accounts. With asset account, when you debit them, they go up, debit up, debit up. With liabilities accounts, when you credit them, they go up. Yeah, when you credit them, they go up. So it's the other way around. Yeah. Does that make sense so far? Does that make sense? Yeah. So it's, you always have to know whether it's an asset account or a liability account. An asset account, when you debit it, it goes up. A liability account, when you credit it, it goes up. Yeah. When you credit an asset account, it goes down. Yeah. Okay. Next transaction. The firm earns 7,000 revenue by providing services to clients. The company collects the cash immediately. Here, our journal entry, we debit cash. Yeah. Why? Because the customers pay in cash. We debit cash, and we credit service revenues. We credit service revenue. When we debit, this is debit. Yeah, debit. When we debit cash, it goes up. Yeah, when you debit cash, it's left-hand side, it goes up. When we credit service revenue, it also goes up. Yeah, service revenue is, this is an asset account, and service revenue is basically, it's an equity account. Yeah, of course it goes into the income statement, but the result of the income statement, which is net income and which is influenced by revenues and expenses, the result of the income statement actually increases our equity. Yeah, so service revenue is an equity account. Yeah, so let's go back and look at it. Here, income and revenue here is a normal equity account. Yeah, that's why it's on the top side. Yeah, on the top is normal. These are all normal, and the bottom, they are the other way around. Yeah, expenses, and it makes sense. Yeah, because income increases equity, and expenses, they decrease equity. They are the other way around. Dividends also decrease equity. That's why here you credit go up. Here when you credit goes up, when credit goes down. This is the next one. The firm performs service on account for 3,000. We have accounts receivable here, 3,000, and no, basically we sorry, let's start with the journal entry. We debit accounts receivable. We debit accounts receivable at 3,000, and we credit service revenue by 3,000. So when you debit accounts receivable by 3,000, accounts receivable go up. Yeah. What is accounts receivable? Is it an asset account or is it a liability account? Can you tell me? What is accounts receivable? Assets. Yeah. Very good. So this is an asset account. When you debit it, it goes up. Service revenue is equity. Yeah. When you credit it, it goes up. The firm pays 2,700 for the following expenses: equipment, rent, employee salaries, and utilities. So you debit rent expense, you debit salary expense, you debit utility expense, you all debit these. Yeah. And you credit cash. Yeah. Why? Because you pay cash. Yeah. First of all, cash is easy. That's an asset account. If you credit it, it goes down. Yeah. All the other accounts here, they are booked into equity. Yeah, they go into the income statement and they reduce equity. Yeah, though they are different than revenue or income, they are the other way around. Yeah, and you see that when you debit it, when you debit them, they go up. When you debit them, they go up. Yeah, we have rent expense of 1,100 debited, it goes up. So we have these expense accounts. And as you see here, yeah, the expense accounts are the other way around. Yeah, they go up when you debit them, and they go down when you credit them. That's the other way around than the normal equity account, like these. That's the other way around, and it makes sense because an expense is the other way around than revenues. Expenses decrease net income, revenues increase net income. Transaction 7, the firm pays off an account payable. The amount is 1,900. The firm pays off an account payable and the amount is 1,900. So you debit an account payable. When you debit an account payable, it goes when you debit an account payable, it goes down. Exactly, Generate. Very, very good. It goes down. Why does it go down? What is it? Accounts payable? Is it an asset? Is it a liability? Exactly. It's a liability. When you debit it, it goes down, and you credit cash. Cash. What is cash? Cash asset or liability? asset, exactly. When you credit it, what does it do? Does it go down or does it go up? Cash goes down. Yeah, very good. So the liability goes down and cash goes down, which makes sense, yeah, because the firm pays off an account payable. Yeah. Do you understand that so far? Does it make sense, or is something unclear? Yes. The others, I hope. Yeah. If not, you are always allowed to ask me, of course. Yeah. Okay, next one. The firm collects 1,000 to decrease accounts receivable. Here we debit cash. Debit cash means it goes. What does it mean? It goes up, yeah, because cash is an asset. We credit accounts receivable. When we credit accounts receivable, what does that mean? What is accounts receivable? Asset or liability? And what does it mean when we credit it? Accounts receivable is assets, yeah, it's assets, and we credit it, it goes down. Yeah, when we credit an asset account, it always goes down. So here, cash is up, accounts receivable is down. The next one, the firm sells half of the land it has bought for 22,000. The company receives 22,000 cash and makes a gain of 2,000 on the sale of the land. We debit cash. Why? Because we get cash. So cash is up by 22,000. We credit land. Why do we credit land? Because land is assets, yeah, and it goes down. Yeah, it goes down, correct? So this is assets. When we debit it, this is debit. When we debit it, goes up. This is also assets. When we credit it, it goes down. And we also credit gain on the sale of land. And gain on the sale of land is equity. It goes into the income statement. It increases our net income, and eventually it increases our equity. The firm declares a dividend and pays the shareholders 2,100 in cash. Which accounts are affected here? Cash. When the company pays cash, it goes down. We credit cash. Cash is down. You credit cash, yeah. And we debit dividends. Dividends, kind of like it reduces our equity. Yeah, it is an equity account, but not a normal equity account. If dividends go up, equity goes down. Yeah, so if we debit the dividend goes up, but the equity goes down because the money leaves the company and the equity is down by the amount of the by the amount of the dividend. Okay, so far, does that make sense? Clear, yeah? If you have any questions, don't hesitate, yeah? You can always ask me. Now, please calculate the balances of all the accounts that were affected by the transactions. So we can do that. Let's say, I hope, do you all have your slides with you? Can you see them? Yeah, because I sent you the slides per email. And you can go back and let's do it. Let's first do that exercise with the dividend. Yeah, we have to calculate with the cash. We have to calculate the balance of the cash. So what do we have here? We have 50,000. We have to add all the numbers that are on the debit side. So it is 50,000 plus 7,000 plus 1,000 plus 22,000. We have 80. We have 80 in total, and we have to subtract what is on the left-hand side. Minus 40 minus 2,700 minus so the balance here, the balance, and it's a debit balance. The balance is exactly, yeah, it's 33,300. Yeah, so this is the balance. For dividends, the balance is, it's very easy. For dividends, the balance is 2,000. Yeah, so I would suggest you try that. But we can also do it together. We can also do it together for the other accounts. So let's go through the other accounts. What about we already did cash? Yeah, it was 33,300. What about here our land? Why is it called generate? Why it's called balance and not sum or total? Because it means that with the balance you have balanced your account. Yeah, you need the balance to balance your account, and then it is balanced. Yeah. So here, yeah, is correct. That's 20,000 is the balance. What about the gain of the sale of land? It's very easy. But anyway, we have to do it. Yeah, 2,000 is our balance. Balance is 2,000. And it is a credit balance. Yeah, this is a credit balance because it's a different account. It's an equity account. It's not an asset account. This is assets. Yeah, and this is an equity account. That's why the balance is also on the other hand side. Cash we already did. Cash we can forget cash. What about accounts receivable? What is accounts receivable? That's 2,000, yeah? Accounts receivable, the balance. It's on the left-hand side because it's an asset, yeah? It's 2,000 is an asset. Okay. What about accounts payable? What do we have here? Or did we already do accounts payable? No, we have to, yeah, we have to do accounts payable. What is accounts payable? What's the balance? Any idea? Yeah, 1,800. And on which side? Right side or left side? Where do I put it? Right, exactly, yeah. Very good. Right side. 1,800 is our balance. So they are easy. Yeah, they are easy. It's 1,100. 1,200 and 400. Yeah. So this is easy. Service revenues. How much is service revenues? How much is service revenues? 10,000, yeah. Which side? Right side or left side? Right side, yeah. Yeah. Okay. I think we did pretty much all of them. Service revenue we had, accounts payables. Okay, supplies. I think we have to do supplies. Supplies is 3,700. There's only one. Okay, we had cash and we had land. This is the only thing I think we didn't have share capital, which is 50,000. Okay, so now let's see whether we are right. Yeah, whether we did it right. Let's see at the end. The trial balance shows all the accounts with their balances at the end of the period. So let's see whether we are right. You're right. Here, for example, cash, I remember we had 33,300. So we are right. So you see here that these are all assets. Yeah, these are all assets, and they have a debit balance. See that? Yeah. And you know, the numbers are correct. We did it fine here. We think we did it right. And these, so these are assets, and these are liabilities. Yeah. So, and that's why they have the balance. Liabilities or equity. Yeah. So this is liabilities. This is equity. This is normal equity, and they have the balance on the other side. Yeah. This is also normal equity here. Normal equity. Numbers are correct. The dividends is a contra account to equity. Yeah, this is the other side. It's a contra account. That's why it's a debit. Yeah, and these are our expense accounts, and they are also in a way contra account because they reduce your equity. Yeah, because the more expenses you have, the lower is your net income, and the lower is your equity essentially. Yeah. So if you look at that, does that make sense to you? Or is there anything unclear? Why something is on the left or on the right? So these are assets here. Beginning. This is accounts payable as a liability. That's why you have it on the credit side. Share capital is equity. On the you credit it. No, they are not sorted by time. They do not have to be sorted this way. They can also be sorted in a different manner. So they are not really sorted by time. But generally, you should understand why those accounts have either a debit or a credit balance. Okay, cool. When you understand it, this is good. If not, then you can ask me. Yeah. And I understand. I explain it again. Okay, we have a couple of exercises, and you should try to solve them. Which account types normally have a credit balance? Think about it and then tell me what is correct. Okay, let's think about it. Revenues are normal equity accounts. They have a credit balance. Yeah, so revenues is correct. What about liabilities? Do they have a credit balance? Yes. For expenses, it's the other way around. For expenses, it's the other way around. That's why both A and B is correct. Yeah. So revenues and liabilities have a credit balance. Expenses do not have a credit balance. If you don't understand it completely, then let's go back and check it. Here we have it. Yeah. This is revenues. Yeah, revenues. They have a credit balance. Here, you see that? Credit is up. With liabilities, it's the same. Yeah, liability is the same. Credit up. And what was the other thing? Expenses. With expenses, it's the other way around. Yeah, you see that? With expenses, they have a debit balance. They have a debit balance. Here, it's the other way around. So revenues have a credit balance. Liabilities have a credit balance. Retained earnings, for example, also have a credit balance. Yeah. Why? Credit up. Share capital, credit balance, credit up. Dividends, not a credit balance because credit down. Expenses also not a credit balance. Why? Credit down. Yeah. So you can always you can look at this slide and then you see, or on this on the other one, one page before, and there you see what accounts have a credit balance and what accounts have a debit balance. So here both A and B is correct. An attorney performs services of 900 euro for a client and receives 100 euro with the remainder on account. The journal entry for transaction would debit cash, debit service revenue, and credit accounts receivable. Debit cash, debit accounts receivable, credit service revenue, debit cash, credit service revenue, or debit cash, credit accounts receivable, and credit service revenue? What do you think? We have an attorney that performs services of 900 euro for a client and receives 100 euro in cash. So what do we have to do with cash? We have to debit cash. We have to debit cash. What do we have to do with accounts receivable? Is accounts receivable an asset or a liability? What is accounts receivable? Asset or liability? No, not a liability. It's an asset. Accounts receivable is an asset. That's why we have to debit it. Debit accounts receivable and debit cash. Yeah. And credit service revenues because it's an equity account. An equity account goes up when you credit it. Yeah. So it's accounts receivable is assets. Yeah, accounts payable is liabilities, but accounts receivable is assets, and that's why you have to debit it. You also have to debit cash, and you credit service revenue. B is correct. Okay, good. Let's go on. Which accounts appear on which financial statements? Here we have the balance sheet and we have the income statement. What is correct? Does accounts receivables, land, and payable appear on the balance sheet? I would say yes. Exactly, Chen Ray? Yes. And does revenues and supplies appear on the income statement? Revenues, yes, but supplies not. Supplies on the balance sheet. Yeah, so A is not correct. What about B? Cash, revenues, and land. Is it all on the balance sheet? What about cash? Is cash on the balance sheet? Cash is an asset? Yes. Land is also an asset? Yes. What about revenues? Is revenues on the balance sheet? Or is it no? Chen Ray, it is on the income statement. Yeah. So this is also wrong. Yeah. A is wrong. A is wrong. A is wrong. B is wrong. What about C? Cash is correct, yeah. Cash is on the balance sheet, receivables on the balance sheet, and payables is on the balance sheet. Cash is an asset, receivables is an asset, payables is a liability. Income statement, revenues are on the income statement, and expenses are also on the income statement. So C is the correct answer. Yeah. Does it make sense? Do you understand? Do you agree? Cool. Very good. Good work. Good job. This is the next one. We have accounts payable. What is accounts payable again? Is it an asset or is it a liability? What is accounts payable, asset or liability? Very good. So, liability. We will have a billing balance of 1,600. Of 1,600. During the period, there were debt postings of 300 and credit postings of 900. What was the ending balance? When accounts payable, as Sue said, is a liability, do I but is always on debit. Debit is always on the left hand side. So this is always debit. Debit is always on the left hand side of 300. And there were credit postings of 900. Yeah. So right hand side is always credit. So 1,600 plus 900 minus 300, and this is essentially what is it? 2,200, yeah, 2,200, and it's a credit, yeah. So the ending balance is 2,200. 2,000. Sorry. 2,200. Okay, very good job. This is correct. Yeah, B. Okay, I would say let's have a break again. Let's have a break.